Good morning, I'm Cherry Reynard, your host for Upfront, where we bring you the latest insights on Baillie Gifford's UK funds. Today I'm speaking with Stephen Hay, co-manager of the Managed Fund, who'll be answering your questions. So do send them by clicking on the speech bubble icon on the right-hand side of your screen. Before Stephen, we have investment manager and Baillie Gifford partner Julia Angeles, unpacking the many ways Moderna is using mRNA technology to tackle diseases like COVID-19. But first, client manager Megan Rooney is here to answer some of the questions that have been filtering into her team over the last few weeks. Welcome to Upfront. Welcome, Megan. Now, you've been with Baillie Gifford for almost 7 years and are now a client manager in the UK Intermediaries team and the chosen representative for the team here on the programme. Can you tell us a little bit about the background to the programme and why we started it?
Morning, Sherry. Certainly. So I think over the last 18 months, there's been increased demand from our clients to hear from us a little bit more regularly. They want to hear about what we're excited about, what investments are filtering through into their portfolios, and performance updates, of course. So we've created this new bi-monthly show to open up wider conversations with our clients. Okay, great. And let's look back over the past 12 months. I mean, it's been a tough year. What's been going on? Yeah, you're right. It's been a very tough year. Volatility over the last 18 months has been very pronounced. And we know there's clients who have trusted us to look after their assets who are rightly concerned about where we go from here. For us, we're sticking to what we know best, which is long-term growth investing. But it would be naive for me to sit here or anyone else from Baillie Gifford and say that we haven't made mistakes. Of course we have. Something that we noticed last year is that we thought the pandemic had fundamentally changed people's behaviours. It turns out old habits die hard, and a lot of those pre-pandemic behaviours snap back quite quickly. So with that, we saw lots of the companies we're exposed to have very dramatic share price falls. But our long-term thesis remains intact, such as the move to e-commerce. So we've been using the recent weakness to top up in positions we're still excited about. But aside from that, there have been more poignant mistakes that we've made. I think we have to be quicker in realising when there's fundamentally something that's changed in the wider or the macro environment that does impact the business case going forward. So the likes of Peloton or Vroom. And then separately, we have to be more mindful about increasing correlations within our portfolio. So even though we own very different growth stocks, they could have similar growth profiles, and that exposes our clients to extra risk. So what we've been doing on the back of that is we've been doing a lot of risk and resiliency work. We went through every single holding and reassessed them. We've been seeing how they fare in periods of higher inflation and if the funding environment is more difficult going forward. And the good news from that is that we're vastly reassured. Our companies in general have higher cash balances, lower debt than the index, and have strong competitive advantages. But I think the one thing we have to be mindful for is that the environment for growth investing going forward is going to look quite different. I think the market has to be more patient, but for us at Baillie Gifford, we've been doing this for over a century and we know how to turn that patience to our advantage.
Great. I mean, you hint at sort of slowing levels of growth and a tougher climate, and certainly it's easy to paint quite a grim picture. You know, there's high levels of inflation, interest rate rises, strike action. It's got a distinctly 1970s feel to it, and obviously that was a horrible decade. Where does that leave you?
Yeah, I think first of all you're right. There's definitely parallels. So geopolitical tensions right now are through the roof. We have that economic uncertainty and we have volatility, all similar to the 70s, combined with the current energy crisis in Europe, which mimics the oil shock of the 70s. So you're right, people think of the 70s as doom and gloom, but what they forget is that it was also a decade filled with innovation and disruption. There were so many exciting inventions that really paved the way for how we live our life in the 21st century.
Okay, give me an example.
Well, aside from the microwave, there is the microprocessing chip from Intel, and that was a huge technological breakthrough which catalysed decades of innovation and shaped what we know as modern day computers. So Intel founded the microprocessing chip in the early 70s, and their sales around 1971 were $4 million per year. By the end of the decade, driven by increasing demand and technological advances, their revenues were up at $663 million. The company vastly outperformed the Dow, and its share price gave returns of over 1,000% since its inception in 1971. So what that shows is that even if you are in those prevailing gloomy macroeconomic conditions, excellent businesses will find a way to innovate and they'll thrive.
Okay, that's reassuring. So what are you telling your clients today about why Baillie Gifford sort of still merits a place in a portfolio?
So if we go back to Moore's Law, which was founded by Gordon Moore, who was actually one of the founders of Intel, that's based on the assumption that computing power is going to double every few years. So by the end of the next decade, we're looking at 60%. If we extrapolate that across the century, that gives us a life in technologies, industries, jobs that are very hard to imagine. And for us, and why we still warrant a place in clients' portfolios, we're looking for the Intels of tomorrow. We're getting to know those companies early, getting to know them early, hold them in your portfolio. So when we see that explosive growth, we can share that and deliver returns for you and your clients. So quite simply, if you want to access the Intels, the Amazons, the Teslas, the ASMLs of tomorrow, that's our competitive advantage, and that's why we still warrant a place in your portfolio.
Okay, great. Now, obviously, market volatility has been kind of top of everyone's mind over the past 12 months. But what else? What other questions are you hearing from advisors?
Yeah, I mean, aside from volatility, AI, I would say, is very forefront at the moment, especially ChatGPT. I think people are worried, journalists, financial advisors, if AI is going to take their job. But before we get into that, I think it's important to say that AI is already here. It's already really ingrained in our lives, and we almost forget about it. So if we look at our phones, predictive text, and also the ability to unlock it with your face now is powered by AI.
Right, so nothing to worry about, or is it?
Well, so if we go back to ChatGPT, that is a sophisticated chatbot, so it will take an input and you can produce a creative output from it. So we could ask it to make some code or write an essay on Romeo and Juliet, and it would do it fantastically well. So much so, lots of students have been using it across the country, much to the displeasure of teachers and universities. And we've saw it explode in popularity over the last 2 months, over 100 million users per month. But there is still limitations to it. The technology is great, and don't get me wrong, AI will change the game, but there are still limitations to it.
And there are kind of different types of AI, aren't there?
Yeah, so that's important to understand. So there are 2 different types of AI. You have narrow AI and general AI. So narrow AI, as the name suggests, it's quite narrow in scope. It can solve a given problem, so ChatGPT. And other examples that clients might be familiar with would be the likes of Netflix and Spotify. They're using narrow AI algorithms to curate content on what you've engaged with previously. The other type is general AI, and that's what people might be a little bit worried about. So that would be AI showing consistently cognitive-like behaviour, much like a brain. But it's important to say that we're not yet there. Scientists are actually disagreeing when we'll get there. Some think it's a decade, some think it's 2, and others don't think we'll ever reach that. And a use case for general AI would be autonomous cars. So we know Tesla, who we invest in, are working on this, and they're making great strides in that, but we're still a long way to being able to be in a car and it drive away on its own. And that won't happen until we have that underpinning of general AI. So the car, we'll think of it, will have to sit in the street, take in location, weather, everything, and be able to react to that accordingly.
Okay, I mean, and that sort of plays to this sort of recurring concern that AI will kind of disrupt the labour market. It'll take jobs that a human might otherwise do. I mean, is that a concern? Is that a factor in your thinking?
I think just now, where we are, it's best used with human intervention. It's making huge strides, don't get me wrong. We're seeing it in things like transport, medicine, also in agriculture with precision farming through a company called John Deere. But going back to the labour force one, there's still limitations. So there was a group of scientists who tried to teach AI to be able to diagnose cancerous skin growths. And when you looked at it at first, the AI was really good at it. But when you dug under the bonnet, the AI had taught itself that rulers were malignant, so that rulers were bad because the rulers are always present in these pictures to show scale. So it just shows that, yes, it's great, but it still needs human intervention and overseeing. And then we've also saw ChatGPT try and convince a man to leave his wife and run away with the AI. So, yes, it's hugely exciting, and don't get me wrong, but there are still limitations. But what we do know is that with that increase in computing power behind Moore's Law, that will drive forward AI. But what that looks like and when we get there, still very much up in the air.
Great. Okay, thank you. That's really interesting. Now, for advisors watching, what are the other things you'd recommend they be keeping an eye on?
Yeah, so I think consumer duty, make no mistake about it, the FCA have stressed that this is a really big focus point for them over the next year. If you or your firm are still unsure what's required of you, please go on the FCA website. They're running lots of roadshows around the country until June, and you can find out dates and locations and how to register on the FCA website.
Great. Okay, thanks, Megan. Now, there will be an opportunity to ask questions on today's topic at the end of the programme. So please do get your questions in using the chat function on the side of your screen. Next up, we'll be hearing from Julia Angeles talking about Moderna.
The drug development process remains hugely inefficient. It is long, costly, and with a high failure rate, leaving millions of patients without effective treatments. On average, it takes more than 10 years and costs more than $1 billion to bring a new medicine to patients. Moderna is a Boston-based life science company, which is pioneering the use of messenger RNA across all imaginable diseases. They're doing this at a speed and scale never seen before in the healthcare sector. This is possible because messenger RNA is a piece of genetic code that allows us to program for any protein. Proteins are the essential biological building blocks that all living organisms depend on to function. For example, in many human rare diseases, the body fails to produce certain proteins. Moderna's technology allows us to produce these missing proteins in exactly the same way as if we produced naturally. In the case of COVID-19, Moderna's technology coded for the spike protein that will be recognized by the immune system, which allows us to build the immune defense against the actual virus. Moderna is a true disruptor of the drug development industry, as it is moving the industry from an analog to a digital age. This is much more profound and radical compared to what Amazon has done to the retail sector, because it concerns human health, and it is one of the most risk-averse industries. We have already seen the power of messenger RNA during the COVID-19 pandemic. Never before we've been able to develop an effective vaccine within such a short period of time. The speed of development and efficacy profile of the vaccine have been truly remarkable compared to other technologies. With Moderna's advancements working with flu and RSV, and an ability to combine the immunization of these infectious diseases in one shot, the company has an incredible opportunity to radically disrupt this market. Moderna is a unique company because it is the first time we see a real opportunity to make drug development a scalable business, which resembles a technology company. This is because of the underlying nature of messenger RNA, being a programmable medicine, combined with Moderna's approach to digitalization of its operations and organization. Currently, the company has 48 programs in clinical development, and many more are cooking in its labs. This scale could allow Moderna to address some of the largest death causes around the world, like cancer and infectious diseases. Moderna's medicine has a potential to impact every life on this planet.
Truly amazing. It feels like there is no end to the possibilities of Moderna's technology. Now to open up wider with a fund update from Stephen Hay, co-manager on the Baillie Gifford Managed Fund. Welcome, Stephen.
Thank you.
Now, you joined Baillie Gifford in 2004, and you also spent 7 years with the Bank of England Monetary Policy Committee undertaking analysis and research. You were even involved in managing the UK's foreign exchange reserves. Now, tell me how you incorporate all this experience and knowledge into your current role.
Well, I think you might expect me to say all that experience is helpful when you're going through different crises, because they are different, and how you handle them, it depends on what exactly has caused them. Or perhaps that macro background at the Bank of England has helped me to analyse inflation in the recent period, and there's definitely some truth in those things. But actually, I think the biggest thing for me, what I've learned over the last 30 or so years, is really about the behavioural aspects of investing, that you need to keep the passion for finding new investment ideas, but you have to keep some of that passion out of your decision making. So you have to be able to remain more impartial, more objective, and sometimes that can help you see where the market has gone too far one way and maybe not seeing where the reality is.
Yeah, that's good experience for the past year, I would imagine. Can you just give me a quick recap on the managed fund, what it does and how?
Absolutely. So the managed fund, we think about it as a one-stop shop for the best of Baillie Gifford. So it's the most diversified fund within Baillie Gifford, contributions of best ideas from all our regional equity teams and from our fixed income teams. And that's brought together into a fund that has a strategic asset allocation of 75% in equities and 25% in bonds and cash. So a more balanced outcome for the investor than just an equity portfolio. And we can vary that a bit through asset allocation.
And can you talk a bit about the managed fund's recent performance and why it's dropped behind its peer group?
Well, as Megan said, it's been a difficult environment for growth investment. I mean, it was a fantastic environment a couple of years ago, and then the last 12 to 18 months has been difficult. Within the sector, there's a huge variety of funds in terms of their equity weighting. It's 40 to 85 in shares. We're at the higher end of that. As I said, 75% roughly is our typical amount in equity. So we are in the higher equity part of that, and that's been part of the reason. We're also in growth equities, and growth equities have been hurt more by the rise in interest rates, because the types of companies that we are looking for are the ones that can grow their earnings over time. The profits are coming further down the line. Higher interest rates means you discount that by more, and the share prices have been hurt. So the style of the equities that we hold has been part of that as well. And we're very much an active manager. We believe that you have to be different from the index or the peer group in order to beat it. So we do expect to be quite different in terms of outcomes from the peer group, but we always ask our investors to judge us over the long run, and for example, at least over 5 years. And over 5 years, we still remain top quartile in the peer group. Okay,
good. Now, Megan said earlier that Baillie Gifford isn't really a sort of macroeconomic house, you're much more stock picking. But is that slightly different for you as a fixed income investor? And actually, does that macroeconomic analysis lead you to certain opportunities?
Yeah, I think my equity colleagues would definitely say the macro is less important. It's all about the companies and what they're doing and their opportunities. But within the fixed income world, those macro elements are a more important determinant of what's going on. I think there's been a really interesting repricing of fixed income markets. So bond yields have risen dramatically, and that's definitely provided opportunities. Just to pick a couple of examples of where we would see the best opportunities. In emerging markets, you've seen those yields really reprice up even more than in the developed markets, and yet there's not as much maybe embedded inflation in those markets. So to pick two examples, Mexico and Peru. So Mexico, we have yields around about 9%. We believe inflation's well under control. And Mexico's a really good beneficiary of nearshoring. So the trend to outsource everything to China has gone into reverse, and Mexico will be a really good beneficiary of that, of sourcing production closer to the US market. So we like Mexico. And Peru's another one where, again, yields have risen to around about that 8% mark. We think inflation's under control. Institutions are well managed within Peru from an economic point of view, and Peru's got lots of copper, and copper's what's really needed as part of the energy transition. So that's a really good tailwind for Peruvian assets. So Mexico and Peru are two opportunities we like right now.
What are you looking for the bond portfolio to do for the fund, if you like? Is it diversification? Is it yield? Is it capital growth?
Bits of all of that, but in particular balance to the portfolio. So we are looking for it to provide some diversification, something different from what's happening in the equity portfolio. And bonds are usually less volatile than equities. Last year was maybe a slight aberration on that, but usually less volatile. So providing more balance to the overall portfolio outcomes. But importantly, within the bond portfolio, we look to find the best possible bonds we can to provide returns within the portfolio. So very much actively managed within the bond portfolio as well.
Okay, and what about, obviously you're looking at risks all the time. Are there any particular areas you'd highlight the moment? I mean, obviously there's been a bit of disruption in the banking sector following the collapse of Silicon Valley Bank. I mean, do you think that's been justified?
Well, I don't think it's a huge surprise that after you've seen such a big move upwards in bond yields, having been so low for such a long time, that we're beginning to see some problems emerge. And it's very difficult to predict exactly where those problems will be. And Silicon Valley Bank was one where it wasn't necessarily expected that it was going to turn out there. But I think there are some unique characteristics about that particular bank that mean that the broad swathe of the banking sector, which we believe is pretty well capitalised, it shouldn't have too much knock-on effect, and that shouldn't be a systemic issue for banks. I would have to say that we don't find the banks as the most interesting place to invest. They may be safer than they were before, but the returns on offer aren't as exciting, and the higher interest rates will be a drag to profitability for years to come, we believe.
Okay, and the fund is overweight in industrials, which doesn't feel like Baillie Gifford's natural stomping ground somehow. Can you talk me through that sort of allocation and where you're invested?
Yeah, some people might think we're all about tech and aren't industrials a bit boring in that sense. And I think provided you find the right industrials, they can be a really important growth contributor to the portfolio. So if I just give you two examples, Atlas Copco, a Swedish industrial company we've held for many, many years, been a real success story. And that's, lots of different industrial components that they are producing, but it's all about how they do it. So it's all about very strong management, great leadership. It's about localized production and making things more efficient and better over time. And they've delivered compound growth of 10% per annum for the last 25 years, which has been a great outcome. But then you can also take advantage of mega trends, as we call them. So Nexans is a French cable company, undersea cable company, which, to be honest, been around for over 100 years, but it hasn't been particularly sexy for much of that time. But now, getting deep sea cables in to bring the electricity back from the offshore wind is obviously a key requirement for the energy transition. So, and there's not many companies that can do it, so Nexans is a great beneficiary from that. So we hold that in the portfolio, thinking it can really benefit from this mega trend.
Okay, great. And just finally, before we go to Q&A, bond yields are up. It looks like a better time for fixed income markets. Perhaps you could talk about a single opportunity that you're particularly excited by.
So we're definitely finding fixed income more attractive. So within the fund, we have added to fixed income, having been underweight for a while. But I would maybe think about probably the things we're most excited about might be on the nexus between between healthcare and technology. So thinking, we heard from Julia about Moderna, which is one of the exciting ones, but there's so many possibilities, and the demand will be really strong in this area for years and years to come. So just to give you, again, a couple of other examples. So CRISPR Therapeutics, so that's a Swiss-American biotech company using gene editing technology to help develop treatments for sickle cell disease, but also for cancer in time. So that's a really exciting area. And Evotech, which is a German biotech company, and it's all about using artificial intelligence to help with the drug discovery processes for companies, making that more efficient. And that, again, is a really exciting area.
Great. Okay, thank you so much, Stephen. And finally, it's time for our Q&A session. Okay, Stephen, we've had a number of questions for you from our advisor audience. You talked earlier about individual business resilience, but in difficult times, there's also a kind of personal resilience element. How do you maintain an optimistic mindset when markets are kind of going against you? And clients are concerned about performance. How do you keep that in your head?
Yeah, I mean, it's difficult, and it's something we have to we work hard to do, because, as you say, there's a lot of negative news around at the moment, especially in the UK, and when performance is difficult, that can be a distraction. So we work very hard as an institution to try and keep those distractions away from the fund managers, so that they can just focus on what the investment case is and what the outlook is for different companies, and not be too distracted by that negative news. And within the managed fund context, Ian McCombie and my other co-manager and myself have worked together for over 12 years. So And many of us at Baillie Gifford have worked together for a long time, so we know each other well. We are very supportive. There's tough questioning. We do challenge each other, but we do it in a very collaborative, supportive environment. And I think that's quite unique in the fund management industry. And for me, that's a really key thing to be able to keep us, optimistic at times when you might otherwise feel a bit down.
Okay, great. A second question. Baillie Gifford is known as stock pickers, but how do you approach this in an income world?
So it's similar but different. So in the fixed income world, it's still about stock picking. It's still about finding those great bonds that the market hasn't appreciated. But you have to be more aware of the downside risk, whereas equities, it's more about the upside risk. But just to give you an example to help bring it to life. So InPost would be a corporate bond that we hold. So InPost, a Polish company which is expanding very fast, rolling out delivery lockers in transport locations like railway stations, which is, I know from personal experience, very handy, very useful. But a company like that has issued debt into the market, raised quite a lot of debt to help fund this rollout plan. The market just sees quite a lot of debt and thinks, oh, that must be risky. Our analysis suggests that the business plan is great, the growth opportunities are very good, and therefore it's not as risky as the market thinks. And that's an example where we see something different from what the market sees, and therefore that becomes a holding in the portfolio.
Okay, great. Next question is on oil and gas, which were obviously one of last year's sort of top performers. The fund holds no oil and gas stocks. Is that a conscious decision? And do you feel like you missed out on last year? Has anything that happened over the past 12 months made you revise that thinking?
Yeah, well, just to correct you slightly, we do hold very, very small amounts in the oil and gas sector. So it's not that we don't hold any oil and gas, but for us, it's not. There's not a blanket ban or anything. The oil and gas companies are just not companies that we have found to be the ones that we think will grow their income sustainably, grow their earnings sustainably over time. And so the business models are not attractive to us. We're looking for the companies of tomorrow rather than the companies of the past. And so oil and gas companies don't very naturally fit into that category.
Okay, that makes sense, absolutely. And just final question. Ian McCombie, your co-manager who you mentioned there, he's said previously that growth is on sale. So have you been seeing this as a buying opportunity?
Absolutely. So within our managed fund asset allocation, we're the most overweight equities we've been for quite some time. We've used up a lot of our cash allocation put into equities. And I see from talking to all our regional equity managers, enthusiasm is the highest it's been for quite a while. Partly that's because the companies that we hold in the managed fund operationally are doing really well. They're not being valued that way by the market right now. So that's the opportunity. And I think I mentioned right at the beginning that with the experience of managing money for a long time, you can see when the market maybe goes too far one way or the other. And for us, the market is just not valuing correctly the opportunities for these growth companies. And we know at some point it will, and we just have to be patient. And that's what we're about at Baillie Gifford, just being patient and taking the longer term view.
Great. Okay. Thank you so much, Stephen, for those insights today. And thank you to everyone who has joined us. To find out more about today's topics, visit www.baileygifford.com. Our advisor team are here to help, so please don't be shy and do get in touch if you have any questions. We'll be back in June to hear from Megan and the US growth team. Until next time, goodbye.